Hey, it's your favorite local broker, Eren Millam with Premier Property Group. Today, we're going to be reviewing a video from Graham Stephan regarding the reverse housing crash of 2024. Let's take a look.
What's up, Graham? It's Guys here.
What's up, Graham? It's Guys here. Anyone else catch that? I thought that was pretty funny. I don't know if he did that on purpose or, that happens when you mix up your words.
And in a weird twist of events, home prices are crashing higher. That's right. Despite 8% mortgage rates, record low affordability, and home sales on pace for the worst year since 1993, home prices managed to hit a brand new record high in September, leaving everybody to wonder, is the market actually going to get any better in 2024?
So, great question. What he said is the prices are going higher because of this crash. Interesting to note there. While that is true because of low inventory, the question is are things going to get better in 2024? Now, we've heard rumblings of interest rate reductions starting to come out in 2024. Maybe late first quarter into the second quarter and throughout the year, up to 4 times. Next year, we should have interest rate reductions. So that should unleash a lot of the pent-up potential. See what else he's got to say.
All right, so in order to understand what's happening, it's first important to see how real estate did throughout previous downturns, because this is where things get incredibly surprising.
So yeah, during the last recessions, the housing market doesn't go down with the recession. In most cases, it goes up. Now in 2008, obviously things were a little bit different and it did go down. So this will be interesting to see what he has to say about this.
However, the most surprising part from all of this is that besides 1929 and 2008, for the most part, home prices have been fairly resilient. Like during and after World War II in the 1940s, home prices and construction boomed from a surge of demand. During the 1970s stagflation era, while stock prices were going down, home prices were going up due to inflation. During the 1980s recession, home prices saw a 4.5% increase as inflation stayed high. The 1990s saw some markets drop, but even the hardest hit markets didn't see a decline of more than 10%. Even the dot-com bubble of 2001 had very little impact in the housing market, because even as stocks fell, interest rates also fell alongside with it, causing home sales to climb to a brand new record high.
What he's saying here is that during recessions, the housing market is mostly insulated. Even if stocks are going down, home prices tend to go up. Now, obviously that's true for one particular reason, and that is they're not making more real estate. So it's always a tangible asset that is going to increase in value. Now, that's not necessarily over the short term. Over the long term, the average appreciation of real estate is 4% each year over the course of 100 years or so. So from 2007 to 2013, you didn't see that appreciation, but then appreciation caught back up and is probably ahead of where it should be during these last couple of years where we've had this boom.
However, even though Wells Fargo believes that we could wind up seeing a similar 1980-style housing recession, to them that doesn't mean necessarily lower prices. In fact, they see it the opposite. Because fewer sellers are listing their homes, Wells Fargo went on record to say that home prices will continue to appreciate at a slightly slower pace because of underlying demand and tight supply, rising 1.8% by the end of the year and 2.5% in 2024. In 2025, Wells Fargo forecasts that home prices will rise by 4.4%.
So that's really interesting. Apparently there was a housing crisis in the 80s, and that's back when I was being born. But home prices went up during this weird housing recession. Now, I can see how that's pretty similar to today's market, because what's the underlying cause of all of this is our inventory is about a third of what we were running over the last decade or so. So that is keeping prices up. Now, we do have fewer buyers who are able to buy with the high interest rates, but our inventory can't keep up with them. So even as buyers, let's say there's 10 buyers, they're going to buy 10 homes. Well, we're putting 9 homes on the market. So it's still going down, even though the buyer pool is reduced. So that's interesting. Something to keep an eye on. Let's take a look, see what else he's got to say.
So how on earth is this even possible? Well, on the surface, most people just pay attention to nominal home prices, which is simply how much did something cost today relative to how much it was a year ago. But if you actually want to get a good understanding of how much something really goes up in price, then you have to take into account inflation. Like, here's just something to consider. Would you say that making a 400% return from 1970 through 2020 is good? Well, if you answered yes, you would be wrong, because you would actually be losing net purchasing power when adjusted for inflation. So when you take this into consideration, you're going to begin to see that we really only saw one decline in the last 50 years, with that being in 2010.
All right, so that's very interesting information. With inflation, there's only been one decline. And I think that is why what makes real estate one of the safest bets to build your real estate, to build your wealth portfolio, is because, yeah, over time it goes up. Now, in the short term, and I think he'll probably go into this a little bit later, is it might not be worth it to buy if you're just going to hold it for a year or two, just because you may not make your money back. Like if you bought in '07, there's a lot of people during the recession in '08, '09, '10, the homes got foreclosed on, so they lost money. Now, that said, as long as you're buying intelligently, you're going to be okay even in a fall. And I can help you with that. And perhaps I can tell you a story about that afterwards.
After all, according to the National Case-Shiller Index, median prices are up 3.9% over the last 12 months, during a time where year-over-year inflation is 3.2%. This suggests that national home prices are really only up 0.7% over the last 12 months, which is completely in line with historical averages. However, some analysts have a completely different interpretation of what they think is going to happen in 2024, and this is where the debate starts. Alright, so in terms of why some analysts disagree with the belief that home prices will continue to stay strong, look no further than Morgan Stanley, because they believe that prices are about to get a lot more affordable in 2024. Or, I guess as they say, we expect home sales to be weak in the first half of next year, but activity should pick up in the second half and further into 2025, and that's primarily because affordability will improve. They also expect that the Federal Reserve will begin lowering interest rates by mid-2024, which would prompt more sellers to sell and more buyers to obtain an affordable mortgage. In fact, they anticipate that rates will be as low as 0.4% by late 2025, meaning according to them, we'll be back to almost 0% interest rates in just 2 years from now.
All right. So if we go back down to interest, the market will explode. Now, I don't know how that would make things more affordable, because the amount of inventory that we have on the market, people are going to go psh and snatch up all that inventory we have. The other thing too is people who want to stay in their homes, maybe they bought recently, they're going to have that 7% interest rate. If it goes back down, there could be a lot of refinances. So I don't see there being this great influx of inventory. And so I'm not sure how that makes it more affordable when prices are going up. But yeah, everyone seems to be for the market holding strong at this price and going up further. Keep that in mind.